Hi, I'm John Fallon from Saunders, and welcome to our second vlog series with regards to issues for licensed clubs. In this series we're going to talk about risk management and how clubs can best present themselves to the insurance market to get the best result in this current market. But any discussion on risk management really needs to be preempted by a discussion on the current insurance market. I've been an insurance broker for 21 years and been in the insurance industry for a lot longer than that, and this is the hardest market that I've ever experienced, and you need to understand why that's the case. So insurers are coming off the back of quite a volatile catastrophe season. In late 2019, early 2020, we had 3 weeks of bushfires. 2 weeks later we had massive hailstorms in Canberra and southern Sydney, followed by 2 weeks later a violent weather cell over Sydney. That cost the industry somewhere between $5 and $6 billion. So their claims costs have increased. Even this year, a month ago, we had storms and floods in Sydney and northern New South Wales, and we're now right in the middle of cyclones in Western Australia. So insurers are out there paying claims. They're doing what they're meant to do and they're doing a great job, but they're passing over a lot of money. Because of those catastrophes, reinsurance costs have gone up. Australia's looked at in a less positive light because of the catastrophes we're suffering. So their cost of reinsurance has gone up. Think of it from a club perspective, your beverage and your food prices have gone up. You can either wear that cost off your bottom line, or you can pass that cost on to your customers. And the last aspect is a lack of investment income. Interest rates are low, they're not making a lot of money on investment. So back in the good old days when interest rates were high, they could take your dollar, they could invest that into $1.17, they can actually run their loss ratios at quite high numbers. They're not getting that capital return from investments anymore, so they have to make their money on an underwriting profit, which means their premiums. So what are they doing? Their premiums are going up. They're trying to reduce their volatility by reducing their capacity. What does that mean? Where they used to write 100% of the risk, they're now writing 70, 60, 50% of the risk to take out the volatility of those really high losses. And the last thing they're doing, and this is where we segue into risk management, is their risk selection has tightened. They're looking at every risk to make sure that they're the type of risk that they want to be underwriting moving forward. So it is so important to get your risk management right and be able to relay the good things you're doing in risk management to the insurer so you get the best result. So we're going to bring in an expert and we're going to talk about that, and hopefully you're going to get something from that. Thanks very much for joining us.